You're listening to BFM 89.9, the business station.
So, Dodge, investors were not too long ago spooked by rising treasury yields and the possible end of the Fed's bond buying. But the S&P 500 rallied about 2% over the last 2 days due to positive job numbers. Are these job numbers sustainable, and are we seeing a structural improvement in the United States?
Good morning, Julian. Well, yes and no and maybe. Yes, the numbers are improving, and this could lead to an structural improvement. No, they are not overwhelmingly powerful enough to get the Fed to start its tapering of its quantitative easing, and maybe that will happen, but at least the Fed now, we're going through part one of the transition in market valuations away from low interest rates. And the first phase, as we said in the past, is a declaration and recognition that tapering is a possibility, but not yet a probability. We still feel it won't start till the third quarter, probably October. But in the meantime, the market was relieved that that employment was not strong enough to change, to speed up, to accelerate the move towards tapering. Also, unemployment ticked up from 7.5 to 7.6%. And this is one of the, according to Bernanke, this is one of the key indicators that they're using to determine whether the economy is strong enough to allow tapering. Now, the good news is that increase indicates more that people are becoming back into the jobs market and looking for jobs because it appears to be more positive, and it's not necessarily negative. And as we've talked about this in the past, we have to go through that phase where people become attracted back into the market. So unemployment will maintain a relatively high rate relative to where tapering is supposed to start. So far, so good. Yes, we're on the right track, but no, not enough yet for tapering to start.
I caught news that Alan Greenspan actually said that tapering was needed. Him of all people, what do you make of that statement?
It was a good confirmation that Bernanke's on the right track. Greenspan does have his views. He's no longer in power. He still holds quite a powerful voice here in the United States. So what he says and what he indicates, because he's known to be a student of the economy, and so he has a deep understanding, and he did a fairly good job regardless of while he was at the position of Bernanke. So I do support his and also Bernanke's positions, and so far so good.
Now, China hasn't been so lucky as far as numbers go. Trade, inflation, and lending data for May were below estimates, pointing to weaker global and domestic demand. Do you think China leaders will capitulate on their no stimulus policy?
They may have to, but I doubt if they're going to do that quickly. I think it's going to take some time. There have been some suspiciously diverging manufacturing PMI data out of China recently, weaker than what the official release was. The real official release was 50.8. The HSBC flash PMI was 49.6 for the first half of May and 49.2 for the second half. Now, exports orders were down for the second consecutive month, and new orders have been slipping to 48.7, so that's under the 50, which is a pretty important reading. It's the first time it's been below 50 since September of last year. So there is some definite weakness, but whether China will respond through stimulus at this point, it's not definite. I think there's going to have to be more proof that the weakness is not just momentarily for the Chinese to change its policy.
One thing that's looking very attractive for China are valuations. A forward PE for the MSCI China Index is just under 10 times compared to the S&P 500's estimated 15 times. Is China's discount attractive enough to price in the problems there?
In absolute terms, yes. Relative to the U.S. valuations, yes. But the real challenge is what's going to happen to the E over time. We really need to see a strengthening of the economy and a strengthening of the earnings. So that is going to be needed first in order to make the current PE multiple, which is relatively favorable compared to the S&P, to make that worthwhile taking the risk. It's probably too soon. We would like to see it increase perhaps to 0.2 increase from where it is now. So it would be 10.2 up to maybe 11 or 12. once we see that trend towards a higher PE, but with the earnings increasing, that's when I think it'll become quite a favorable buy.
And a big chunk of the S&P earnings also come from overseas countries. Do you think that the 15 times offered by the S&P 500 right now is a fair number?
Fair number it is high. It is questionable because the future of earnings, it is under question, under investigation. Right now, the power of our earnings has really been created by a very cost-cutting measures and trying to keep expenses down, not necessarily towards sales and revenue growth. So the sales and revenue growth part of the earnings is the most important part to analyze here in the United States, and we are not seeing the growth in sales and revenues, nor are we seeing it in terms of company projections and company estimates for the future and how they're leading investors. We need to see that first before we really are convinced that our PE makes sense. And really, it's sales and revenues that are going to be the driver in terms of our market multiples being reasonable or not.
Gold prices have been rocky lately due to the rise of treasury yields and also at the fringe news of India raising gold import duties to 8% from 6% before to address its current account gap. Should investors now consider gold as part of their long-term asset allocation?
Well, we're not as constructive about gold. We remain very bearish. We've seen some improvement over the last 6 to 12 months, but really in terms of bullion shows no signs of reversing its major stage 4 downtrend. At the same time, even the shorter-term trend for bullion is weakening once again, and as anticipated, the near-term rally has failed to close above the 1422 resistance level that we feel is good resistance. If bullion could get above that, then I think there could be a further move to the upside. But there really is no conviction in terms of gold over the long term. It's had quite a move. I think it's going to take more time. We're also very bearish on bonds and fixed income at this point. Neither of those appear to be attractive, particularly if interest rates start to increase. So we're more likely to stay away than to be attracted towards gold and fixed income.
Thank you, Dodge. That was Dodge O'Dolan, Chairman and Chief Investment Officer of Lander and Fused Capital Management in New York.
BFM 89.9, the business station.